I want to start with something that changes everything about how you should be reading what is happening in the gold market right now. Gold is down 21% from its peak. Bombs are still falling in Iran, and the biggest buyers who drove this bull market are selling, not because they changed their minds about gold, because they have no choice. I spent 48 hours going through central bank disclosures, vault flow data, and IMF filings. What I found is not what Wall Street is telling retail investors. And until you understand it, you cannot understand why what is coming next will be larger than anything we have seen in this cycle. Turkey's central bank sold 60 tons of gold in 2 weeks, $8 billion. That is not a portfolio adjustment. That is a sovereign nation being margin called by a war. Let me explain the mechanism because this is the part nobody is explaining clearly. Turkey imports 90% of its oil and 98% of its natural gas. When the Iran war began and Brent crude went from $75 to over $100 per barrel, Turkey's annual energy bill increased by $20 billion. Immediately, not gradually. Energy contracts are priced in dollars. Turkey needs dollars to pay them, not lira. The Turkish lira hit fresh record lows 11 times in 16 trading days. The currency is in free fall. Turkey's central bank faces 3 options. Let the lira collapse, political suicide, burn through dollar reserves, already doing that, already low, or sell gold, take the dollars, defend the currency. JP Morgan estimated $30 billion in precious metals held at the Bank of England could be used for operations. Turkey chose option 3. 60 tons in 2 weeks. This is forced liquidation, a margin call, except instead of a retail trader getting a phone call from their broker, it is a sovereign nation forced to sell gold reserves to defend its currency in a war it did not start. Turkey is not alone. Russia's central bank began selling gold in 2025 to finance war expenditures, raising $2.4 billion through February 2026, reducing holdings to a 4-year low. Poland's central bank, the most aggressive gold buyer over the past 3 years, has proposed monetizing 550 tons of reserves for defense spending, $13 billion. The governor outlined the proposal in early March. China's PBOC paused purchases in Q4 2025. India's central bank became a net seller in January 2026 as the rupee came under pressure. Think about that list. Turkey selling, Russia selling, Poland considering selling, China paused, India selling. These were the most active buyers. Together they represent a simultaneous shift from net buyers to net sellers or sellers in waiting. If the central banks that drove gold from $1,800 to $5,596 are now selling, what comes next? The answer, when I look at the data carefully, is the opposite of what most people assume. This is the most important insight I can give you today. I have watched 4 major resets in the gold market in 40 years of managing capital: 1976, 1983, 2008, 2013. Everyone followed the same pattern. Forced selling hits the market. Central banks that spent years accumulating are compelled to liquidate because a crisis destroyed their dollar inflows and they need cash to survive. The gold price falls significantly. Retail investors conclude the bull market is over. They sell. That adds to selling pressure. The price falls further. Then when forced selling exhausts itself, when the crisis stabilizes, when dollar demand normalizes, the structural buyers return. The central banks that were forced to sell do not abandon gold as a reserve asset. They sold because they had no choice, not because they changed their strategic view. When they can buy again, they buy. The fiscal constraints driving Turkey and Russia's selling are conflict-specific, not policy shifts. If Hormuz traffic recovers and oil retraces toward $85 to $90, lira pressure moderates, intervention selling slows, the supply picture normalizes. The long-term demand floor remains structurally intact. Reserve diversification away from dollar assets, geopolitical fragmentation, fiscal deficits in developed markets, these continue to provide conditions under which central banks have structural incentive to hold gold. This is the reset, not the end of the bull market, the clearing of excess, the forced liquidation that creates conditions for the next larger move. Why am I calling this the biggest reset yet? In 1973, When gold began its historic run, U.S. national debt was $500 billion. Today it is $39 trillion. That is not a larger version of the same thing. That is a categorically different fiscal reality, creating categorically different structural demand for gold. In 1973, no central bank was buying gold strategically. The infrastructure for sovereign accumulation barely existed. Today, central banks are forecast to purchase 850 tons in 2026, still elevated far above the pre-2022 average of 400 to 500 tons. In 1973, there was no silver supply deficit, no AI infrastructure driving industrial metals demand, no de-dollarization movement of the scale we are witnessing now. When the U.S. froze Russia's currency reserves in 2022, policymakers across the developing world took note. If your reserves can be frozen with a keystroke, they are not really yours. Gold is different. No counterparty risk. Cannot be printed, devalued, or sanctioned. That realization did not change when Turkey was forced to sell 60 tons. Turkey still knows gold cannot be frozen. Turkey sold because it needed dollars in a crisis, not because it decided gold was no longer strategic. When the crisis passes, Turkey will buy again because the logic that drove accumulation has not changed. Same for Russia. Same for Poland. Same for every central bank forced into selling by dollar demand created by the Iran war. This is not the end. This is the biggest reset within the bull market. Resets create the most significant buying opportunities in any long-term trend. Let me give you the three-phase playbook from here. Phase 1 is what we are in now, the forced liquidation phase. Gold is near 4,128, down 21% from its all-time high of 5,196. The sellers are not making strategic decisions. They are meeting obligations. Turkey defending currency, Russia funding war, Poland considering defense spending. Selling pressure is real, large, and by definition finite. Countries cannot sell more gold than they own. The question is how much forced selling remains. Turkey reported drawdown of 58.4 tons across 2 weekly periods. JP Morgan estimated $30 billion could be used for further operations. That number has a ceiling. Turkey does not have infinite gold. Saudi Arabia's holdings, 323 tons, appear unchanged per IMF data with no confirmed sales. UAE holds 11 tons. Kuwait 79 tons. Gulf states selling rumored but not confirmed in data. What is confirmed is Turkey and Russia. Phase 2 is stabilization. This begins when oil stabilizes, when Saudi pipeline capacity and alternative routes absorb enough Hormuz disruption that emergency dollar demand from energy importing nations moderates. Trump has been making noises about Iran negotiations, talks already underway according to the president on March 26, though denied by Tehran. When oil stabilizes in the $85 to $95 range, marginal dollar demand forcing Turkey's hand diminishes. Lira stabilizes, forced selling slows. Gold recalibrates towards structural price rather than crisis liquidation price. Phase 3 is structural re-entry. This is when central banks that sold during crisis begin rebuilding, not immediately, but within the 12 to 18-month window historical resets have taken to complete. China and India have not signaled reduction in accumulation programs. PBOC extended purchases for 15 consecutive months through January. Strategic buyers have not left. They paused or were forced to sell temporarily. When they return to a market where forced selling already occurred, where price already reset, where accumulation opportunity is larger than at previous highs. Then there is Russia's April 2026 deadline. Russia is banning gold exports from April 2026, making it illegal to export bars above 100 grams. Every Russian gold holder who wants ability to move assets freely has a window of days to sell before that window closes. That selling adds near-term pressure. But when it exhausts itself, when pre-deadline liquidation completes and export ban takes effect, a significant source of selling pressure is removed permanently, and a significant producer is locked out of international market, tightening future supply. Two things I am watching to identify when Phase 2 begins. First, the Turkish lira. When lira stabilizes, when pressure on the central bank to sell gold diminishes, one of two largest confirmed sources of selling pressure will have turned. Watch the USD TRY exchange rate. When it stops making new records, watch gold. Second, the Hormuz situation. Every week the strait remains disrupted is another week of elevated dollar demand. Every week oil stays above $100 forces Turkey's hand, drains Gulf reserves, pushes central banks toward liquidation. Watch Brent crude, watch tanker traffic data. When oil falls toward $85 to $90, the fundamental driver of this forced selling sequence moderates. JP Morgan raised its gold target to $6,300 by end of 2026 with an $8,000 upside scenario. Those targets were set before Turkey's $8 billion sell-down. They have not been withdrawn. Institutional research departments are not watching gold fall from $5,596 to $4,128 and concluding the structural case changed. They are watching forced liquidation create the buying opportunity before the biggest reset yet. I have been through enough cycles to say this with confidence. Forced selling does not change the destination. It changes the price at which you can get there. The biggest reset yet is happening right now as Turkey sells final tons, as Russia approaches export deadline, as Poland debates monetizing reserves, and as China waits patiently with accumulation program intact. The reset creates the floor. The floor, somewhere between $4,000 and $4,500 based on everything I am reading, is the launching pad for what comes next. Watch the lira, watch Brent crude, be patient. Do not let a phase of forced liquidation you now understand make you miss the biggest move yet in the gold bull market.